That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves, get you up to speed on the action from today's trade. Let's take a look at the major averages here. We end here in the green. The Dow up about 90 points. The S&P 500, your broad gauge, is up about 0.4%. And the tech-heavy Nasdaq, that is going to tack on about 0.3%. We do have, of course, a potential U.S. government shutdown to consider. We spoke to a policy analyst on the show earlier today, said the odds of the shutdown, in her opinion, they're looking high. And that would have implications potentially for the release and the publication of government data, economic data, that jobs report. But markets right now seem to be shrugging this off. And frankly, September ends pretty solid as we now wrap up the third quarter. Stocks finishing the day higher as a potential government shutdown looms. For more, we want to bring in here Arnim Holzer, global macro strategist at Easterly EAB. Arnim, always great to see you, especially on set. Let's start here, Arnim, because it was a strong quarter for the markets. Let me get your thoughts just on Q3, what you saw, and now look ahead. And I'm curious to get your take on whether you think this momentum continues.
I think it's a great question. This quarter shows you how important it is to have earnings momentum. It shows you how important it is to have hope around secular themes. We had a very interesting dynamic around inflation. We had an interesting dynamic around trade policy, concerns, perturbations. But at the end of the day, this market has really taken hold of this idea that there's still upside. There's still some hockey stick around CapEx, around earnings, around growth. And despite some of the risk issues, which do look a little complacent in terms of the way the markets are looking at downside, it is all about hope around that hockey stick of growth. That doesn't necessarily mean that this continues, but I think even today's reaction with the government shutdown coming tells you that equity markets are looking at this setup as a different kind of construct, but not necessarily, a terrible one to fear.
Give me your reaction to the market's reaction to this looming government shutdown. What do you make of it? Which feels like a shrug.
It doesn't just feel like a shrug. Yeah. It is a shrug, and it's a shrug both on the fixed income side and it's a shrug on the equity side.
Are markets being too complacent, in your opinion?
Well, I will say this, that when we look at the way stocks are performing, because of the drive towards some of these smaller, some of these disruptive companies, you're seeing a disconnection in correlation on the stock side. So implied correlation is down at about 10, which would imply there's no macro at all. And the reason for that is that there's a tremendous amount of equity index volatility being sold, and people are buying individual stocks. And so it really looks like people are piling into idiosyncratic risk, and they're saying, look, if I buy really good names on these secular themes, if the market goes down, some of these companies are still going to win. And so it kind of makes sense when you dig, but at the end of the day, there are risks here. And if you get not a 7-day cycle of shutdown, but you get more like a 30, 35, which we have seen in the past, there can be economic effects. I mean, there is clearly an effect to GDP if you get a month of no government workers getting paid, right? So we can't ignore that. But at this moment, the market's really more focused on what's going on in terms of growth, productivity. And as a result, they're kind of ignoring the risks here. That doesn't mean it's right, but that's what you saw today.
Let me ask about earnings, because earnings season is going to be here before we know it. Absolutely. What are your expectations? What do you think you're going to hear from CEOs and CFOs? What does corporate profit look like?
Well, it's interesting. When I was here last spring, late spring, we discussed the idea that the corporate boardroom was going to be critical to see what CapEx really came into this AI and this productivity miracle. I think we can both agree. The boardrooms have been investing. The numbers have been staggering. And so what we think you're going to see, because of productivity and because pricing is still relatively good, remember, inflation being slightly at the higher end of target means nominal growth, and nominal is supported, which is good for earnings. So, somewhere around 7 to 10% this year, maybe a little better earnings growth, means the year probably is going to be a good year. So that's not so scary. But the issue really is, as we look at the amounts of money that are being spent, the incremental dollars, are they going to have the payoff? And you're beginning to see in some of these names, for example, in some of the power names, you're beginning to see have these kind of generated to levels, PE levels, that are very heady for them. Are they going to be able to, in 26, deliver the same kind of growth? What's going to be the adjustment? I think for this quarter, there's going to be some rationalization of future expectations, but not to the degree where you're going to see a massive correction. But I do think you're going to start to see some preparation because the amounts of CapEx that are being delivered basically mean the return of capital to investors is going to be lower because the investment in the business is going to be higher. So far, investors have gone with it and said, Meta, this is great. You want to build out CapEx? We love it. Alibaba, you want to build out CapEx? We love it. But there does come a point in time when the PE reaches a certain level where investors start to wonder, okay, where's the return of my capital? When am I going to start seeing dividends and buybacks? There's going to be a point here in the next quarter. It might be first quarter of next year, but we have to start to see that happening because this has been a very compressed CapEx expansion. And I do think at some point investors are going to say, okay, how do we see the payoff here?
What did you make of Jay Powell's recent comments where our own Fed head seems to suggest we're stretched here?
Well, my 35 plus years of experience, I remember some of our Fed chairmen making comments about other industries, biotech, et cetera, et cetera.
Right.
And they're not usually great stock pickers. And it's not my job here to be a stock picker either. But I will say that valuation connotes future return. So when you're in the top quartile of valuation experience in a sector, you have to expect that the next 3 to 5 years, the returns are going to be maybe in the lower half to lower quartile of expected returns. That's not a hard and fast rule, but it's not a wrong-headed way of thinking about it. I think what the Fed chairman is saying is we have to be careful about what we assume the returns here are going to be. And unless the Fed really eases a tremendous amount, it's hard for me to see multiples expanding a lot from here.
Arnim, always great to see you, especially on set. Thank you, sir.
My pleasure.
Well, markets wrapped up the trading month of September and the third quarter of 2025. For a closer look at the leaders and laggards, we have Yahoo Finance's very own Jared Blikre to break it all down.
Thank you, Josh. I thought we'd start with the Dow because very fitting that to end Q3, to end the month of September, which was supposed to be bad, at least according to history, the Dow closed at a record high. And here is a total for the month of September, up not quite 2%, but I think investors will take that given the seasonal headwinds. Here's the Nasdaq, more than double that, up almost up over 5.5%. And then the S&P 500, 3.5%. And I also want to rattle off some statistics here. This was the best September for the S&P, the Nasdaq Composite, and the Nasdaq 100 since 2010, and the best Q3 since 2020. And I also want to cover the small caps because the Russell 2000 recently finally closed at a record high a few days ago, and that was the first one in, 4 years or so. Guess what? Best September since 27, best Q3 since 2009. And so really exceeding expectations here. And if you take a look at what happened in the month of September in sectors, you only see two that are outperforming the S&P 500. In the upper left there, we got XLK, that's tech, and then XLC Communication Services, where you find Meta, but also Alphabet. Alphabet just had a blockbuster month. We'll get to that in a second, but let's go down. In third place here, we have utilities. Let's not leave out the other part of the AI trade, and then consumer discretionary. That's Amazon, that's Tesla, plus all these retail names. What did poorly? Well, that would be consumer staples, the stuff you need, and that's more of a defensive sector. And then we also have materials, energy, real estate, and financials in the red there. But let's skip over to the Nasdaq 100. And again, this is just for the month of September, but Tesla here is a real big standout, at 33.2%. I also mentioned Alphabet, 14.2%. And by the way, Tesla only became positive in the year 2025 a couple weeks ago, and now it is riding on 10% return as of the end of the month and quarter here. Let's skip over and, one more thing. Apple made a nice comeback too. I didn't want to leave out Apple. That was up about 10%. But also taking a look at the Dow, aside from the mega caps, let's sort by performance here and figure out some of the bigger winners. IBM, this is a stock that broke out a few years ago. You can see it's up almost 30%, not quite at the highs of the year. It's been chopping around a bit, but very nice comeback for Big Blue. Then Caterpillar in number 2, that's up 14%. United Health over 10. And we mentioned some of those larger caps. What did not do well this month? Nike, Boeing, Salesforce, all of those down more than 5%. You can throw Sherwin-Williams into that as well. And I thought it was really interesting to look at the month of September. Some of my winners and losers here, almost everything in the green. And guess who's leading? ARK Invest. So disruption came back. It wasn't just some mega caps. We saw a broad mix of, let's call them fringy kind of stuff, some stuff that you like to bet on, some of them moonshots. Well, ARK up 15%. Followed by biotech. We didn't see a strong showing from healthcare, but biotech within healthcare did well. And then we got Korean stocks. That's a chip proxy. And guess what? The SOX, which just hit record highs a couple days ago, that is up 25%. And then for the quarter, we saw that up about 13.5%. But it wasn't just semiconductors. Software did well. IGV, that's my software proxy, that was up 5% over these last 64 days in the quarter. For the month, up about 6.5%. And I'm just going to go over to our, let's do this. Let's go to semiconductors there. This is what happened in the month, and I'm going to sort by performance there. And you can see some real outsized winners. Western Digital up almost 50%, Micron up 40%, Intel approaching 40%, and Lam Research over 30%, along with Marvell and ASML. Really outsized performance there. And then you take a look at what happened in the quarter, a lot of those numbers jump up even more. Western Digital up almost 90%, Lumentum up 70%, Intel increasing its stock price by 50%. And I'll just chart that for you. This is what happened in the months of September. This is what happened in the quarter. So really nice showing and comeback for Intel there. You put it all together, we had a few losers, but for the most part, it was very much a winning month and a winning quarter. Back to you guys.
All right, thank you, Jared. Nike's first quarter results just hitting the wire. And Yahoo Finance's Brooke DePalma joins me here with a closer look at the numbers. Brooke.
Good afternoon. What we're seeing right now is that Nike's revenue did come in as a beat. Now, keep in mind, this is a company that is navigating a turnaround strategy as well as tariffs, President Trump's tariffs that are hitting the footwear industry. And so right now, revenue coming in $11.72 billion. That was compared to an estimate of what Wall Street had expected of $11.02 billion. We are also getting a look that inventory did come in higher than expected at $8.11 billion. That's compared to expectations for $7.92 billion. But I do want to jump over to their investor relations page, because what we're seeing right now is that $11.72 billion number, that's up about 1% compared to a year ago. There was large assumptions that we would see sales decline as this turnaround strategy went underway and as the company navigated returning to their wholesale model compared to direct to consumer. Nike Direct, speaking of, that's their direct to consumer model. They did see revenue decrease about 4% to $4.5 billion. When it comes to their wholesale revenue, that was actually up about 7% to $6.8 billion. And we've heard Nike really looking to return to JD.com, return to Dick's Sporting Goods. And that's been an effort under the new CEO, Elliott Hill, who now took the helm about a year ago. But in the results, he did say that this was a result of their what they're calling their strategy win now actions and the prioritizing of North America wholesale as well as running, the product initiatives around running, specifically getting back into that sports focus. But Josh, I do want to dive in to see if they did mention anything about tariffs, and they did within the release. They said that gross margin decreased 320 basis points to 42.2%, primarily due to lower average selling price. They said they were doing less promotions, reflecting once again higher discounts and channel mix, as well as what they said was higher tariffs in North America. Now, this was a company that did say that they were going to take a $1 billion hit from tariffs. And so now we're seeing that play out a bit within their gross margin number as well.
All right, thank you, Brooke. Appreciate it. Well, for more on Nike's results, want to get now to David Swartz, Morningstar Senior Equity Analyst. David, good to see you. So Nike reports the stock, David, it's up about 3% here. What did you make of the report, David? How does it compare and contrast with what you had modeled?
Yeah, it looks like that the sales were a little bit better than expected. And, you know, that's typical for Nike. Even in bad quarters, Nike tends to outperform estimates. We were looking for a sales decline of about 5 or 6% in the quarter. So a small increase is a positive. It looks like that the benefit was really on the wholesale side. Nike did have a number of new product releases in the quarter and continues to release new products. Nike has released a whole new line of running shoes for 3 of its major brands, Pegasus, Structure, and Vomero. And it looks like those have been well received by retailers and by the public too. And I think that selling of those running shoes and other products helped the sales in the quarter.
Let's talk about CEO Elliott Hill, David. You know, his plans. his strategy for Nike. Based on these results, is it working, David?
Yeah, I think it is working, but we're still far away really from what Nike should be reporting. This is a company that typically reports sales growth in the mid to high single digits, and 1% gain on a relatively easy comparison with last year is nothing to get too excited about. But Nike has been struggling now for almost 2 years, so it's certainly positive to see them, I think, turning a corner. It's probably going to be a few more quarters before we really see some strong results. But I do think that they're coming. Next year in calendar 2026, Nike has the Olympics in February and then the World Cup in the summer. Those are going to be two great events for Nike to do a lot of promotions. Certainly the World Cup is going to be a huge event next year because it's in North America, and Nike has invested heavily in its international soccer business. So, Nike has a lot of new products and marketing opportunities coming, and I do think that retailers want Nike to succeed because this is still the company that drives this whole market, and I think that hasn't changed despite Nike's problems over the last few years.
What about tariffs, David? How is Nike navigating that dynamic? What are the levers that Elliott Hill is pulling there?
Well, there's a number of things that Nike can do. It can renegotiate with the manufacturers in Asia. It can renegotiate with other parts of its supply chain, including even trucking and shipping and things like that. And it can also increase prices when necessary. Nike has suggested in the past that it will really try to avoid price increases on footwear that costs less than $100 a pair, which is really for a more value consumer. Nike knows that if they try to raise prices too much on some of its lower end product, that it could definitely lose market share because that's a very, very crowded market. On its higher end product, I think Nike can raise prices $5 or $10 a pair, and most likely consumers won't notice too much, especially since everybody else in the industry is going to be doing the same thing. Adidas has said out loud on its earnings calls that it's going to follow Nike in terms of price increases in the United States, and so I think we'll see that. But right now the sportswear market is not particularly strong, so it's hard for these companies to actually raise prices until it improves.
You mentioned Nike's rivals there, David. I'm just curious, how has the competitive market, the competitive environment, how has it been shifting for Nike? Are rivals taking share?
Yeah, at times Nike certainly has lost share to some of the newer brands like On and Hoka, but also some older brands like New Balance and Brooks and Adidas that have been around for a long time but have been very competitive in recent years. There's no question that the sportswear market has become more competitive in the last 5 or 6 years, and really even more so in the last 2 or 3. And that comes at the same time that Nike has been struggling a bit. So, Nike has been fighting to regain some of that shelf space and floor space with retailers. But as I said, I think those retailers are receptive to giving that floor space back to Nike when Nike has the products that bring in customers, because it's still a brand that attracts a lot of sales and really generates growth for this entire industry. And so retailers like Dick's, which just combined with Foot Locker, of course, I think they really want Nike to be successful, and they will go back to highlighting Nike's products after a few years in which they were maybe highlighting some newer stuff even more.
You call Nike, David, undervalued. What would be fair value?
Yeah, my fair value estimate is $104 a share, and that's before today's report, so it could change a little bit, but I definitely think that Nike is undervalued right now. The stock is down over 100 points from its all-time high when I rated it as very overvalued at that time, and now I think it's gone in the other direction. Nike historically has been a great stock to buy when you buy it in down periods, and there have been some down periods before, including about 10 years ago, when it proved to be a great buying opportunity. I think that will happen again, because realistically, this is still a growth market for sportswear worldwide. Nike just did a new product release in Africa, for example. It's the first time they released footwear in Africa before anywhere else in the world. And that shows that there are still markets out there that are still relatively small, but are going to get bigger over the next 10 or 20 or 30 years. And Nike's in position to benefit from that because it's still by far the biggest company in this industry.
David, always appreciate that instant analysis. Thank you, sir.
Thanks.
Time now for what to watch Wednesday, October 1st. Starting off in Washington, we're watching for any deals to avoid a government shutdown. President Trump meeting with congressional leaders on Monday. trying to reach a deal before the Wednesday deadline. Moving over to earnings, we're going to be getting more reports on Wednesday, including Conagra and Cal-Maine. Conagra announcing results for the first quarter before the markets open. Higher costs for cocoa and eggs, plus tariffs on steel and aluminum are squeezing profits for Conagra. Analysts also expecting Conagra sales to fall up to 6% in Q1, driven by weaker demand, foreign exchange pressures, and selling off the Chef Boyardee brand. And taking a look at the job market, new data coming in on Wednesday with ADP employment. Economists forecasting that number to come in at 51,000, signaling that private sector job growth is slightly slowing. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered the next half hour with the latest and greatest market moving stories. Stay tuned.